Welcome to USAWatchdog.com. I'm Greg Hunter. Our next guest I hadn't been on in a while, and actually wrote me an email and said, "Hey, Greg, I haven't been on in a while, but I got some things to talk about." Actually, has some predictions, which is unusual for him because one of the things that sticks out with this individual guest who I've had on several times before, bright guy, you'll love him. He said that, hey, you can only predict the end of the world one time. So he doesn't predict the end of the world, but he predicts some pretty good things for gold and silver and oil and copper. And I'm talking about Craig Hemke, who's got 20 years experience in the financial services industry, a licensed guy, also analyst at tfmetalsreport.com. Craig Hemke, thanks for joining us today on USAWatchdog.com.
Greg Hunter, glad to be here, my friend. Yeah, we got a lot to talk about. This is going to be an interesting year. As you said, I might talk in generalities about how, gold's going to go up and silver's going to go up, but, we don't often talk about specific price levels because you said, that's an old Art Cashianism, if you will, from my days when I was at Payne Weber. You don't go around predicting the end of the world because you're only going to be right once.
That's right. But you with predictions is unusual because you don't really predict other than, like you said, general things. But hold on, I'm going to go to full screen me, and I just want to start. You sent me a bunch of stuff. You've done a lot of analytical work here, but I just picked out a couple of things that just jumped out at me, and maybe we can start there. And we're just talking about gold, silver, oil, the dollar, just things like that. Those are going to be big deals. That's going to be a big part of the financial story. And there's good reasons why. Here we go. I just want to bring this out. And first of all, I wrote on this is my nomenclature on here. This is the U.S. dollar. And, right here, it was 103 at the beginning of 2017. I've been harping on this. My guys know I've been harping on this. And what's happened? Boom. Greg Manarino says, would you buy this stock? Anyway, and then if you look at the dollar, so that's the dollar. So let's come in here, and then we'll look at gold. And so look at gold. This is 2011, the high, around 1900. Boy, sure to spend a lot of time in the 1817s up there. But, you down, and then we got a smiley face. So just to look at the overarching thing. So we have a smiley face, a frowny face in the dollar. And we have a smiley face. Let me get this right. There we go. So here we have the frowny face in the dollar. And we have a happy face in gold. And let's just start there. Why the frowny? Let's start with the dollar. Why the frowny face in the dollar? The chart looks like, doesn't look good.
Greg, first of all, I want to commend you on your technical skills. This is some high-tech stuff we're doing here.
Yes,
man.
high tech. But it just jumped out at me, man. That's all. I'm just looking for a place to start.
I'm joking. In fact, one of the things people liked when I first got my start is I could not, for the life of me, figure out how to do a chart electronically and upload it and all that kind of stuff. So I would print off a chart, break out the ruler and the Sharpie and draw and then I'd have to scan them in and do all this stuff and write on them by hand. And people thought that was great. Well, that was the way, we used to do it 20 years ago. So that's why. So anyway, I'm just teasing you. All right. So putting this all together,
let's start with the dollar because that's the big story. The dollar. Hold on, I'm going to go full screen here. So the dollar, wow, since the beginning of 17, it's down 14 points or something. It doesn't look good. Go ahead.
Keep that on the screen for a while.
Okay.
On the left-hand side, where it goes straight up, that's in 2014, where the dollar went from 80 to 100. Use your other finger, your right index finger. I'm sorry, and people will see that there's a section there. Yeah, right. And you see where it went straight up there below Greg's index finger.
Yeah.
Anyway. Back in the day, in 2014, when this was going on my site, we called it the Great Disinflation or the Great Deflation Bias. And the dollar took off from about 80 on the dollar index up to 100. You see it on the screen.
Yes.
That's when, remember crude oil used to be up around 100 all the time?
Yeah.
It broke down through 95 and 90, and then, my goodness, went all the way to like 30 eventually. But when it was really falling was while the dollar was really rising. Copper broke down, silver went down, gold all commodities went down. Again, that was deflation, when the dollar was rising. So now here's the Fed. They're doing everything they can to spark inflation. Now, look, you and I know there's inflation. You and I know we can go to the grocery store, and a gallon of milk and a pound of steak, all that. It's not what it used to be. But the way they measure inflation is low. And they do that, well, mainly to screw all the old people out of their cost of living adjustments for Social Security, but that's a whole other story. The Fed is trying to spark inflation to justify raising interest rates the way they want to. Well, they're not having any luck, right? And so you got the Fed wanting a lower dollar. You've got the President of the United States wanting a lower dollar. Lo and behold, the dollar's going down. It was a year ago this time when the predominant story was king dollar, right? I mean, the dollar was going to soar and all this kind of jazz. That's when you point out the dollar looked like it was breaking out to the upside, got to 103. Instead, last year it fell by 10%. And now, so far this year, it's already down about 3%. And here we are just in early February. Now, it's not straight down. It's probably not going to plunge as rapidly in 2018 as it rose in 2014. But anybody can look at that chart and go, well, I can sure see it. Like Greg Manarino told you. Yeah. Would you buy this if it was a stock? No, because anybody can look at that and see it's going down. So this has significant implications going forward as we move into this year and next. And those are the predictions that you mentioned earlier. I mean, as the dollar falls, if it was tremendous disinflation or deflation on the way up in 2014, then the opposite is true. It is inflationary on the way down. So far, we've already seen copper break out of a big smiley face, long-term weekly bottom. We're now seeing crude oil break out. It's above $60 and the highest prices since when? 2014. It's up to about 65. It looks like it's headed back maybe toward 90, just as the dollar looks like it's headed back toward 80. And here's where it then gets interesting. You mentioned the gold chart. We can talk about the silver chart, all these other commodities that have a similar look to them. Where this might get rather compelling in the next, let's say, 18 months is that you would probably recall, we go back to when QE first began here in the States and really around the globe in 2009 and 10. People were reading up books on the Weimar Republic. I mean, I know I talked about it all the time because we saw this just open money printing. Trillions and trillions of dollars and euro and yen were being printed to save the banks, and the central banks bought garbage bonds from their primary dealer banks in exchange for new cash and all this kind of stuff. At the time, you couldn't help but think this was going to be hyperinflationary, and that's why people were reading about the Weimar Republic, like I said. Well, as it turned out, a lot of that new currency that was created ended up being quarantined on these bank balance sheets. And more technical analysis of the economy showed like money velocity, which is something, where you can measure how quickly money is turning over within an economy, fell to 50-year lows and all this stuff. So there were a number of reasons why all of this currency that was created didn't lead to hyperinflation at the time. So now here we are, though, almost 10 years later. And this is what now is starting to come about. Not a full-blown, take wheelbarrows of cash to buy a loaf of bread kind of stuff. But what we will start to see is a recognition now of a falling dollar, beginning stages of recognizable inflation. I mean, like I said, the Fed wants the falling dollar so they can generate what is called cost push inflation, get the input cost to go up. Maybe that gets passed along to consumers, maybe wages go up, all this kind of stuff. Anyway, putting this all together, as inflation grows and as these commodities begin to break out of this pattern that you can see on those charts, funds will begin to flow into the commodity sector in general throughout this year and next, much like 2010 and 2011. The early stages of this rally is where we are now. You can see it again on that chart that you've got, or you've got a chart of gold as well. As though recognition of this rally takes hold, and as money managers around the globe, there's, what are they? I don't even know how much, what is it? Trillions of dollars in pension funds and hedge funds and stuff like that. They're all in the stock market. They're in the bond market, all these overvalued sectors. Well, as money managers begin to go, okay, look, I got to take some money out of these overvalued sectors and put them into undervalued sectors. Well, what's undervalued anymore? Commodities, really, and that's about it. So this flow of funds will begin that will start these prices of commodities moving slowly at first, like they did in 2010. But then it begins to ramp up quickly. And again, why would that be? $15 trillion worth of QE has been applied, dollars worth of currency created in the last 8 years. Everybody thinks the U.S. isn't doing QE anymore. But hell, the Bank of Japan, the ECB, they're still doing it. So there's these trillions and trillions of dollars that are sloshing around the planet. And when they all head in one direction, you get things like Bitcoin. Well, Now, if all of this money starts to head in the commodity direction due to falling dollar and recognition of inflation, all this stuff over the last 18 months, commodities are going up, as is crude, as is silver. And again, like I said, I don't want to make it sound like it's a simple thing that's going to move in a straight line. But it doesn't, we're not splitting the atom here. This is pretty straightforward stuff, and I think people would be wise at this point to position themselves ahead of it.
One of the things you brought up in your research, and there's a bunch on this. So go to TF Metals Report. I don't know if this is paid for content. I know you have some free stuff, and you have content. You have a big community and stuff too. But one of the things you pointed out was political and geopolitical risk. Wow, I'm reading this morning. About the FBI are basically what somebody said threatening Donald Trump. Trump doesn't work for them,
right?
And the Congress doesn't work for the FBI and DOJ. Congress oversees them.
Yeah,
and it's just outrageous. And they're wanting to. They're talking about sources and operations or sources and what do you call it? What do they call it? Sources and whatever else, methods. Sources. You mean like using that phony document? Methods. You mean like using that phony document, applying for a fraudulent application for a FISA warrant?
Right.
Because you were turned down the first time?
Right.
I mean, This is outrageous. Is there is that what you're talking about? Political and geopolitical? Yeah. Let's start at home here. How can this disrupt the financial system here? All right. And incidentally, hold on a minute. Sure. We're not way off there either. In this financial order, in the December financial order, where he talked about sex traffickers and the corruption, he talked about destabilization of the financial system from these people.
Yeah. Yeah.
I mean, so you're not way wackadoodle off base here. This is according to the executive order on 12/21/2017. Tell me about your geopolitical and political. Let's start with this release the memo, the FISA thing.
I'm laughing because I caught myself. You held that thing up, and you got to warn me when you do these things. So I had to squint, and I was like, "What does that say?" So anyway, I'm laughing because I couldn't read what you.
Well, here, hold on. Let me show it to you. I have this on my.
Oh man.
I have it right here, man. It is the. Put your glasses on. Read it. You can read it. Here you go. Right here. Let's go big picture.
Yeah, gotcha. All right. Let me, rather than comment specifically on the FISA thing, because that's obviously going to be in the news today and going forward. Let me get back to what you mentioned about dollar and political risk, because I've written about this earlier this year, and this is something we're going to be talking about all year. I've called it the three major themes for 2018. If you remember, the last time I was on here, Greg, was sometime in 17, and we were talking about what I call the generally accepted narrative. And it was this theme that was shoved down everybody's throats after Trump's election about how great it was going to be. The dollar was going to soar, and interest rates were going to soar, and all these different things were going to take place. And we said, well, that's probably not. And of course, the dollar went down 10%, and interest rates on the long end were down as well. All right, so our big three themes for this year all have to do with the dollar. So we've already talked about the Fed wanting a lower dollar. We've talked about Trump wanting a lower dollar. But at the same time, they can change their minds, right? They could say, well, and we saw that last week. Trump comes out and openly contradicts Mnuchin, which that in itself does not instill confidence in the dollar, right? Because you're like, what kind of clown show is this? One guy says one thing, his boss says the next. I mean, that's not a good thing long term for the dollar either. But back to these three themes. These three primary themes will impact this dollar going down gradually, consistently all through this year. What are they? Political risk. You mentioned the FISA stuff, but I'll give you something that, again, no one's really even talking about at this point, is what if by summertime that it becomes clear, or it becomes increasingly likely, that the Republicans are going to lose control of Congress? I mean, at this point, a lot of people aren't expecting that. But what if they do? And what if by October and November, we're talking about an entirely Democrat-held House of Representatives and Senate and impeachment hearings? Because that'd be the first thing they do. Well, there's a risk to the dollar that nobody's talking about. Then we've got geopolitical risk. Well, obviously that has to do with Korea, but also what's the events in the Middle East. the events the U.S. is forcing in the relationship with Russia, everybody else's relationship. I mean, there's all kinds of geopolitical risk as we go through the year. And then lastly, and I think this is just as important, continued de-dollarization risk, we'll call it. The dollar is the world's reserve currency. It remains that way. But there are clear challenges being presented to it. The Chinese have been working to build an alternative platform using their currency for at least 20 years, but they've really ramped it up in the last 10 since the financial crisis. We are waiting patiently, I might add, for them to begin trading their own currency, yuan-denominated crude oil contract. And that could really upset the global dynamic in terms of demand for dollars. That goes all the way back to 1973, when Kissinger first put forth the idea to the Saudis to only price crude oil in dollars. That creates demand for dollars. It's a recycling scheme of dollars. It keeps it locked up in treasuries, keeps dollars on oil exporters' capital accounts and in their reserves. Well, if all of a sudden there's an alternative that you can price crude oil in yuan and a reason to do it, well, again, that's just another cut in bringing down the dollar. And so you put all these three risks together: political risk, geopolitical risk, de-dollarization risk. Throw that log on the pile with the Fed wanting the dollar to go down, with Trump wanting the dollar to go down to spur exports, etc. You can see how these pieces fit together. And like I said, I feel like if you look at the chart, you can pull up that monthly chart of gold that you had earlier.
Hold
on. Again, if the scales don't look the same, it's because that dollar chart is a weekly chart.
No,
the gold chart is a monthly chart.
Hold on.
I'll just keep going. Gold was kicking butt up until 2008, and then it went down from 2008 into 2009 with the financial crisis, and then it was rallying like crazy all the way to 2011. But gold and silver were kind of stalled out for a little while in early 2010. Heck, by summer of 2010, silver was about where it is today, 17 or 18. It only began to move into the 20s by the end of 2010. And then it went from 22 to 48 in about 6 months. And that was before there was $15 of QE sloshing around the planet. So this could all still get very disorderly and even more crazy than it was in 2010 11. And frankly, I just
You mean $15 trillion of QE?
What did I say? Billion?
You said $15. 15. I'm sorry, I don't mean to correct you, but I know you, because I do the same thing. I think one thing is, am I not saying something else? But you meant $15 trillion sloshing around.
Yeah, what's a few trillion between friends, right?
Okay.
So anyway, again, there's I'll just use this analogy again. When I first bought Bitcoin in the summer of 2016, it was when I finally figured out the supply-demand dynamics of it, that the supply was being increasingly thinned while demand was increasing and acceptance and awareness was growing. I thought, well, how does this not work, right? Now, what's happened in the last 45 days notwithstanding, everybody knows it went from 100 to 1,000 to 10,000 to almost 20,000 as this mass of global liquidity all flooded toward it. Well, the same thing could be said not only even for this hyper hypothecated, digital forms of gold and silver exposure, but how about the mining shares, for crying out loud? There's only, they can always increase the float and do secondary offerings and all that kind of stuff, but there's really only a pretty fixed supply of high quality mining shares out there. What's going to happen as, again, asset allocators, money managers, hedge funds, pension funds, as they begin to see this commodity sector rebound on this sinking dollar, and an increasing amount of flow of funds comes in, almost kind of a virtuous cycle. You get higher highs, and then it pulls back, and more money comes in, and it goes even higher, and then people go, wow, this is really breaking out, and even more money comes in. And you get a chart that almost kind of looks like that Bitcoin chart. Look, I don't think, your average mining share is going to go up by 100 times like Bitcoin did, but it's a similar dynamic. And so anyway, that's the point of this forecast. It's not to sit here and say, gold's going back to 1900 by this time next year, and then going to 5,000. There's so many other things that go into, a price forecast than just simply looking at the dollar. What I'm trying to say, though, is people need to recognize an opportunity when it presents themselves to them. we've had to sit and put up with this garbage for the last 5 years of prices, just getting continually pounded and rallying and then getting beaten back. But now you can see on the chart, and it's not just gold. It's also silver, it's crude oil, it's copper, it's all these other industrial commodities. Zinc has doubled in price in the last 18 months. I mean, this isn't, like I said, this isn't complicated. You can see this happening.
You're saying every chart that you said, actually it does. I looked at all your charts and put this in your work. Every chart is flashing a smiley face. This chart from
exactly.
And it's over a couple of years now. It's not just
right. And then you look, and then there's all kinds of other technical factors and fundamental factors you can look at. But just on like I said, I don't know. I've been doing this long enough, and I've got a pretty good memory. And I've always said about my only talent I really have is a memory and a knack for pattern recognition. I'm just saying we've seen this before. I mean, it doesn't mean that hanging around and having to put up with everything from 2013 to 2016 was no fun. It was no fun at all. But again, we've seen this before, and this to me looks a lot like 2010. 2018 does, and I just wanted to get the word out that there's an opportunity here for people that want to take advantage of it.
Let's say, but what isn't like 2010 and the dates you mentioned, what isn't like 2010 and 2008 is they're going to clean house at the Justice Department. I mean, there are many people implicated. I mean, and the Democrats and the FBI are fighting it, and then you're hearing Brennan, oh, that's reckless, releasing that, and they're releasing our sources, and our operational secrets, which is crazy. But a lot of people are fighting. Adam Schiff, a Democrat on the House, says if they release this man, it'll likely lead to the firings of Rosenstein, the number 2 at the Justice Department, and Mueller, who is stinking to high heaven with his Uranium One, not stopping Uranium One. Back in the day, he was the FBI director. So there could be many people in top positions in just those 2 agencies fired. Does that help or hurt the dollar? Some people say, "Oh, it'll help the dollar." And initially, even Bill Holter said initially it's not going to help the dollar. Long term, it will.
Greg, I don't think it does long term either, because you don't know how this is going to play out. I mean, anybody how this memo sorts itself through may be initially viewed as being a good thing for Trump, but that is fleeting. They'll just come back at him with other stuff probably. And at the end of the day, regardless of that, none of this instills confidence in the dollar. And when you can move funds around the planet in a nanosecond at the speed of light, right? And you can dump your dollars and you can buy your whatever else, euro, whatever other currency, and then go buy their government bonds. You can buy European bond. You can buy European stocks. You can buy Japanese stocks. You can do all kinds of other things. If you look at the U.S. and view it as a mess politically, and like I said, this show last week of Mnuchin on one day saying, "Oh yeah, we want a weak dollar," and then the next day Trump, his boss, comes out and says, "No, we want a strong dollar." People throw up their hands. They say, "Well, I'm not even going to mess with that." So in the end, it'll be interesting to see how this all plays out politically and from a news standpoint, and drain the swamp and all that jazz. But it doesn't bode well for the dollar in any sense at all.
Are your subscribers? You have a pretty tight family of people, pretty big family actually. What are they saying on your, in your private subscriber list, which I'm sure you've drawn a lot of very smart people? What are they saying? What are you hearing repeatedly? What's the theme that you're hearing?
Politically, economically, which direction you want me to go?
Just in general, what are they scared of? What's the theme that you hear over and over again? Oh my gosh, I didn't know this was going to happen, or whatever. What jumps out at you about comments that your subscribers, your people are making?
I think a lot of folks are, I don't want to say excited, but they're very interested to see how this thing plays out with Trump and this memo and how that might impact, and trickle down through all Washington and what it might do to some of the corruption that is found there. Now, that's one thing that a lot of folks pay close attention to on my site. I think probably the biggest hot button issue that people are trying to figure out of my subscribers, and I got to tell you, this is always has been one of the big drivers of people to my site, is the community of people. that we're all in the same boat rowing together. And so they're out, the subscribers post great content to every single thread we start, sifting through what's on the internet. And I think economically and from a market standpoint, the thing that has people most curious is the bond market.
Yeah.
And because, you got people like squeaky Bill Gross out there trying to call a top to the bond market and a 30-year bull market ending and all that kind of stuff. And you could say that. At the same time, though, you could also say that long end has been in a range now for 5 years. And though the 10-year has moved up in the rate that it, is now at, what's like 2.7 or 2.75, and the long bond's up to 2.95.
Yeah, it's only 24, 25, 26, in the 20s basis points difference.
But we were at 3% in the 10-year note in 2013. Or I guess it was early 2014. And so, was the bond bubble bursting then? And so I'm reluctant to jump on board. And I think that's the main thing that people are, discussing, debating on my side as to whether rates are going to start moving higher on the long end and what it would then mean in a number of cases. Because, if you go back, let's just tie this again in historically. You go back to the late 70s. That was the last time gold really went parabolic, right? And it got all the way up to whatever it got to, $900 an ounce or something like that. Well, what was going on then? Interest rates were skyrocketing. The dollar was plunging. We had inflation, whip inflation now and all that kind of jazz. So higher interest rates historically don't mean falling gold prices. In fact, even as recently as 2004 through 2007, the Fed hiked at 17 consecutive FOMC meetings, and gold went from 400 to 1,000. Okay, so anyway, there's a lot of debate about this. I'm still in the camp that it's going to be next to impossible for the long end to rise significantly just because of the increased interest costs on the U.S. on the national debt and in the deficits. But at the same time, since the banks or the central banks are willing to print as much cash as it takes, and there's all this cash out there, maybe it doesn't matter what interest rate, what the bond markets or what the interest rates are and what the line item is on the debt. At this point, we're going to cut taxes to nothing and we're going to increase spending. Trump's going to spend $1.5 trillion. I've yet to hear where that's coming from. We'll just borrow it. We'll just print more. And there don't seem to be any consequences. So maybe the bond market doesn't matter at all, Greg. Anyway, I feel like I'm kind of talking myself into circles, but it's a very interesting time to be alive, my friend. And this is a year for people to be paying attention. And if you want to make some fiat, it's there.
The overall trend for 18 and beyond, you're going to get inflation. How much? We'll see.
Right.
Listen, Craig Hemke of tfmetalsreport.com. We'll put the links up, after the interview section. Hey, thanks. You delivered. Thank you for coming on and making some predictions. It wasn't the end of the world, but it's the end of, no inflation and deflation. It looks like that we're going to have some inflation. Craig Hemke, thanks for joining us today on USAWatchdog.com.
Greg, it's always a pleasure. Let's talk again soon.